Hi there. If you're married in the UK, this video explains how inheritance tax planning works in 2026 and how to use your allowances effectively.
Couples operate on the assumption that leaving their entire estate to a surviving spouse is the safest way to preserve their wealth. But under the rules taking effect in 2026, this simple decision often pushes total family assets past a point of no return. While the spousal exemption still protects the survivor upon the first death, the entire estate is reassessed under a new set of conditions when that survivor passes away. Many assets that were entirely tax-free just 2 years ago will soon be subjected to a 40% inheritance tax bill. This is a double taxation event. After the 40% inheritance tax is deducted, beneficiaries are hit by income tax on remaining funds. For some families, the effective tax rate on an inherited pension or business asset reaches 67%. Without updating your strategy, the standard spousal will has become the most direct path to a major wealth reduction for the next generation. To understand why this is happening, we have to look at the math of the allowances. A married couple can currently combine two £325,000 nil-rate bands with two £175,000 property allowances. That creates a total tax-free ceiling of £1 million. The Chancellor has locked these thresholds in place until April 2031. As inflation rises, the real-world value of that £1 million protection is being steadily eroded. On April 6, 2027, unused pensions will be dragged inside the taxable estate. Add an inherited pension to an ordinary £800,000 estate, and it instantly breaches the £1 million limit, triggering a tax charge on the excess. While business owners and formers are currently focused on a new £2.5 million cap on their specific reliefs, the new pension inclusion is what will catch the majority of UK homeowners. By expanding the taxable estate to include assets once considered private, the system is now capturing wealth that previously sat out of reach. There is a widespread belief that a deceased partner's unused tax allowance moves to the surviving spouse automatically. This is a misconception. The transfer requires a manual claim. Executors must submit HMRC Form IHT 402 to prove exactly how much of the first spouse's allowance was left unused. This claim is subject to a strict 2-year time limit. Executors often have to locate decades-old paperwork to confirm marital status and asset values from the time of the first death. If the paperwork is missing or the deadline is missed, that £325,000 allowance is lost, regardless of the couple's marital status. Relying on the default spousal transfer provides no protection if the family fails this administrative requirement after you pass away. Strategies designed for the previous tax regime often ignore the 2027 inclusion of pension pots in the inheritance tax calculation. One potential fix involves drawing down defined contribution pensions more aggressively during your lifetime, paying the required income tax on that money today. You can then pair those pension withdrawals with the surplus income exemption. This allows you to gift the net cash to your heirs, effectively moving wealth out of the taxable estate entirely. A second option is the 10% charity rule. Leaving exactly 10% of the baseline estate to a UK-registered charity reduces the inheritance tax rate on the remainder of your assets from 40% to 36%. In this new landscape, proactive gifting and strategic withdrawals must replace the habit of simply letting wealth accumulate in a pension pot. Sit down today and calculate the current value of your home, your savings, and your defined contribution pensions. If the combined total exceeds £1 million, your current will and pension nominations are likely out of date. You should consult a tax professional to restructure your estate before the 2026 and 2027 deadlines arrive. The cost of inaction is leaving 40% of your lifetime's work to the tax office rather than your family.